First of all, welcome everyone to the 2025 review and 2026 outlook. I always enjoy doing these presentations. It's great exercise to spend time digging into the data, the predictions. We say this all the time ad nauseum. The markets do what the markets do, and we employ a strategy that is very diversified, but it can be interesting from a thought exercise standpoint to sit down and think about what might happen in the coming year. So just like we always do with this review and outlook, we'll spend a little bit of time talking about the year that was 2025. And then we'll also come with data around what we think is on the horizon for 2026, knowing that there are years where things go according to plan and there are things where crazy things come out of nowhere. So with that, I will just say again, welcome everyone. We're excited to have you, and I'm excited to be doing this presentation with Cliff today.
I'm excited too. Thanks, Damaris.
Yeah. So Cliff, if you want to go to the next slide,
Okay.
we will just briefly show you our standard disclosures. These are important, and maybe the primary thing is investing involves risk, and we want to make sure you know that. So good reminder there. We'll keep going. All right, so this is where we begin talking about 2025. Maybe some of you remember the beginning of the year last year, and we were kind of coming into another market year after 2 prior good years and wondering what was ahead of us. Importantly, analysts make predictions at the start of every year, and 2025 was no different. So as we're taking a look at this slide specifically, there was a wide range of different predictions, Stifel being one of the lower outliers, predicting the S&P 500 would end at 5,500, and then Oppenheimer being possibly the highest prediction. So where did the S&P 500 actually end up? 68.45. So kind of a little bit towards the top of the middle, but I think the important thing to remember with predictions and why we're reviewing this is we had a market experience that felt very volatile at some point. There were times in April where we had people reaching out to us who felt very nervous around what was happening, but the returns don't actually reflect panic. It was up and to the right. And I think the other important thing to remember is even the professionals don't agree sometimes. So it's a good reminder not to anchor on any single number. And with that, we'll look at predictions for 2026. You can kind of see here, again, somewhat of a wide range. It'll be interesting to see where the year ends up. But more importantly, forecasts are a range of plausible outcomes. They are not instructions for the market. I would just encourage everyone to remember that. While we're kind of getting into things, I will share that if you have a question that you'd like us to address, you can go ahead and put that in the Q&A box. We will do our best to respond to those sort of as we go, but certainly if there are any left at the end, we'll try to address those as well. All right, moving to the next slide. So this is a fun chart. This is S&P 500 versus headlines. Now, as we look at this, we see there were a lot of headlines. Headlines can impact the markets, both good and bad. So you see there are significant dips. There are some ups as well. Generally, the market shrugs these off, and it did move higher in 2025. The investor mistakes that were made this year in 2025 often happened because they were behavioral or emotional moves. If you had just kind of gone to sleep on the 1st of January 25 and woke up at the end of the year, you would feel like it was a pretty good year. And that was the case. The disconnect between headlines and reality can be pretty normal, but it is, you can make mistakes if you ignore it. And Cliff, anything you have to add here?
No, yeah, my favorite, story from this year. One of them was a client called in wanting to move a large sum of money out of the markets in mid-April, Todd convinced them to actually put some more money into the markets and said, we'll talk in 5 years about this particular bucket of money and tell me if you're upset that we invested in April of 2025. So hopefully that client's happy that they did do that.
I think that's a great reminder. And also, while we're sharing anecdotes, I think what was interesting is some of the younger people that I work with, younger clients, were a little nervous, especially around April when the market was dropping on the headline tariff news. It's kind of interesting to remember, if you don't have a lot of market experience, then the last couple of years have been really good. It starts to feel pretty scary when things are moving down. So again, we always talk about discipline. We know what works, but those short-term moves can certainly feel more scary. Absolutely.
Yeah, and this has been the strongest 3-year period since before the dot-com bubble. We'll get into more of that, but so it does tend to lead to a little more fear. But as you can see here, we had a lot of new all-time highs. All those green dots are new time highs last year. And when you have one new time high, you're likely to have another one because the market is generally up. And I will say, over the last 40 plus years, the average intra-year decline is a little over 14%. So we did see that this year. That's nothing out of the norm.
Great reminder, Cliff. So what actually happened in the different asset classes in 25? This is where we kind of have this handy chart showing what each of these asset classes did over the last calendar year. Notably, you can see the big blue bar that shot up in the middle. So one feature of the markets last year that was a bit interesting was international stocks outperformed U.S. markets, and specifically these developed market stocks, the MSCI EAFE and emerging market stocks, MSCI emerging markets. Each of those gained approximately 30% in U.S. dollar terms. That is really, truly incredible. So U.S. markets did great, but international markets did even better. Cliff was sharing some data with me before we got on this call, reminding that it is historically a trend that after international markets have a good year, they are likely to have another good year. So obviously take that with a grain of salt, but kind of interesting to think about what was happening on the international front last year. This strong performance kind of reflects two important factors. One of them is improving growth expectations in many economies around the world. And the other one is the weakening dollar. That boosts returns for US-based investors when foreign currency gains are converted back to dollars. So just kind of an interesting thing also with the currency to keep in mind there.
Yeah, and that stat that I shared with Damaris was that it was the largest international outperformance since 1993.
Incredible.
I'll tell you how old I am. That's when I graduated high school. But the clusters around those big years in the past have never been by themselves. So it's usually been, three or more years that international outperforms domestic stocks. But never know if that's going to be the case, but just kind of an interesting tidbit.
Mm-hmm. I won't share where I was in 1993.
You were born.
And I wasn't born yet. So one other thing I'll point out on this slide is fixed income has played an important stabilizing role. The Bloomberg U.S. Aggregate Bond Index gained 7% for the year, which compared to 30% in international markets doesn't feel like that much. But as the Federal Reserve continues cutting interest rates and inflation stabilizes, higher quality bonds have been serving their traditional purpose by providing income, helping offset stock market volatility during periods of uncertainty. And that's an important thing to keep in mind too, while stocks are getting a lot of attention.
Yeah, and I don't think bonds felt great at some parts during the year, but as we'll see later on, as the longer end of the yield curve has risen, it's, as Damaris says, that's really done its job. So,
moving to the next slide, we felt it might be important to address the fact that we are going into a midterm election year. So it'll happen in November. There's going to be an inevitable rise in political noise, as always. And this kind of adds to existing political developments which are impacting markets. So we're thinking about tariffs, regulation, government spending, tax policy changes, all of these can kind of cause short-term volatility. And there's also going to be a lot of different things being said by different candidates that can cause people to feel one way or the other. I think the important thing that we wanted to point out here is that midterm elections have historically actually had very little impact on overall market performance. And this kind of ties back to a point that we've made at different times during election seasons in general, which is that having a red or a blue president doesn't necessarily have any impact on the market in a tangible way. So obviously, politics can feel very outsized in our heads, but when we actually look at the data, this graph showing stock market returns in election years kind of is beginning to prove that point. Again, going back into the data on this chart a bit more, well, midterm returns are slightly lower than in other years, and you can see midterm election years are represented by these orange bars. They do remain positive and healthy by historical standards, and also important to know the details behind this. The performance in these years was not necessarily the result of midterm elections, but other factors. So if you're going to have, different things happening, correlation does not equal causation necessarily. Cliff, anything to add on that?
No, yeah, I agree with you. This is more of, it's just more noise, and I really don't think who wins affects companies in the United States or elsewhere. It's really, it's more about your taxes probably than anything else, and less about that. But I mean, yes, there can be you'll see later, some stuff around deregulation, other things that can affect companies, but for the most part, it doesn't matter.
And one of those really big things affecting taxes going forward has already happened, and that's probably not going to be reversed in the near term, at least.
So turn on to valuations. You hear a lot about this in the market, that valuations are high. And yes, by most measures, they are high, but that in itself isn't necessarily a signal that we need to be sellers or get out of the market. It does mean to stay focused on diversification, because even though values here look high, there's other parts of the market or other investments that valuations are not as high. International on the value side, energy, financials versus tech, consumer, or communication services, which kind of higher PEs. But corporate fundamentals are strong. S&P 500 companies have had really strong earnings growth. It's projected that to have double-digit earnings growth for the next few years, so that's not going away. And so I think a lot of the market hope is that we can grow into this multiple, because it's not necessarily PE is kind of forward looking, so it's saying we might have better times ahead still to come. That's why the market is at this valuation level. So again, that's really the reason why we want to be diversified. As you see here, I'm looking at the S&P 500 concentration. So we've heard a lot about the Mag 7. The top 10 companies in the S&P 500 make up almost 41% today. That's very high compared to historical averages. If you look back to the dot-com bubble, it was about 28% that it almost got to. So we're much above that. But there's a definite reason for it this time. When you look at the percentage of earnings that the top 10 are contributing to the S&P 500, they're a third of the earnings of the whole index. So they're making a lot of money. And so that's the reason for these valuations to be so high. So if you look over on the left side, you see that the average is 20.7 for the top 10. The average for the remaining companies in the S&P 500, the other 490, is just under 16%, which that's not historically that high. If you look at what the average is for 30 years on this one, it's 17. So we really are seeing kind of a skew by these big companies, but again, it has been for a reason, because they have been making so much money. So this kind of turns to look at that year-over-year change in return on the left side. So you can see this is the Mag 7 now. Those returns have been positive for the last 3 years, over year-over-year positive returns. In 2023, that blue represents how much of the return change came from PE. But if you look after 2023 into 24 and 25, really it's been driven by earnings. So these companies have been going up because of all the money they're making. And the other thing I'd point to on this slide is that a lot of this earnings is being poured right back into CapEx. And the reason for this is because they really do believe that there needs to be a lot of money put back into AI investment. So even though it seems like a ton of money is flowing into that, it's only accounted for about 1% of GDP. During other tech cycles, CapEx has been about 2 to 5% of GDP. So we're not even seeing like the same level of investment that this would have been in previous cycles, perhaps. So I expect this trend to continue, and we'll know when it's not continuing, when the hyperscalers kind of tell us, oh, we're not allocating as much capital there this quarter. And we get the quarterly calls. They've been consistently, we're going to put more money into this. Some of them started taking on debt. Oracle's been notable for that. So their stock has actually been punished for that because they have a lot of long-term leases and high debt. But the other companies really have not, well, Meta has a little bit of debt, but the other companies really have not been takers of debt. So they had the opportunity to issue long-term fixed rate debt that they have plenty of cash flow to pay the interest on. So there's other avenues for them to continue reinvesting into AI and their infrastructure. Anything you'd add to those, Damaris?
Yeah, I actually do think there's an important reminder here too. The Magnificent Seven is a term that started getting thrown around a lot last year. Before that, we weren't really hearing about it as much. The Magnificent Seven are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Just a reminder that this is kind of something that's been sort of steadily growing, and now, all you hear all the time is Mag 7 this, Mag 7 that. But when we're talking about the Mag 7, that's what we're actually referring to, is that group of companies that have increased in value so much that they are sort of dominating the markets. And when they have a bad day, the markets have a bad day too.
Well, yeah, we went from FANG, remember FANG stocks? That was what Facebook, Alphabet, Netflix, and Google. And then it went to FANG with 2 A's because Amazon got in it. And then it went to like Mananga something. now it's Magnificent Seven. So this has been a trend of some of these large companies driving the S&P 500 performance. But I think we'll see that kind of spread out now. There'll be more, when you get to these concentration levels, they don't last, but they don't have to end badly. So I think we could see, other, and they do have earnings projections for, the other companies picking up, while the earnings projections for the Mag 7 will be slowing down. So I think we'll see that kind of right itself. And I don't think it has to be disorderly per se, but.
Just a reminder to anyone, if you've got a question, you can throw it in the Q&A chat. We'll try to get to it. But I know we're moving a little fast through some of this data because we have a lot to cover today.
This is just a reminder that the top 10 companies don't stay the same over time, and they will go away. So all the ones that were in the top 10 in 1985 are no longer in the top 10. So sorry, Kodak. I did hear Kodak might be making some sort of a comeback. The kids are into like retro cameras, so I don't know. But in the current one, only Microsoft, it's kind of Microsoft's the old one from 05. Everybody else is newer this year, or have kind of come three from 10 years ago. So this changes over time, and so what we have today in the top 10, not likely to be in the top 10 20 years from now. 10 years from now, maybe. Given the size of Apple, Nvidia, Microsoft, I don't see how those leave in the foreseeable future, but just a reminder that the top 10 changes over time, and the direction of the market that's gone over time. even when the top 10 are at the same top 10, the market has still generally gone up over the last decade.
I think this is also maybe a good time to just remind people in general that we can get very hyper focused on a current company, a current trend, a current innovation, and if you asked a lot of people what was happening 10 years ago, they might be hard pressed to remember, that they've made investment returns and they might remember if it was a particularly bad year. But again, kind of just a point towards diversification, being very intelligent about the investments you make, but then kind of letting the market do what it does, which is go up over time.
Yeah, I was really surprised to see that GE made it all the way to 15 because I remember during the financial crisis in 0809, GE was not doing well. But yeah, it is amazing to me that how these change over time. So with that, we'll turn over to the Fed, and this will get into sort of more of the outlook for what could happen. As you see on this chart, it kind of shows you rate expectations. The gray is where the Fed has been over the last year. So you can see they've been all over the place in terms of where they thought we might end up. Currently, the blue line is the Fed. So the Fed thinks one more cut in 2026. The market thinks two. A lot of the managers that I listen to are saying two. So we'll see. There'll be a lot of argument about that as we go forward. And they also disagree on our ending rate. So the market thinks that rates will come back up. The Fed thinks we'll end kind of at a terminal of 3, 3.1 there before 3 is kind of the rate that they're looking for. So we'll see. In the path of debate, it's going to be back and forth between inflation and labor. An increasing number of FOMC participants have talked about inflation despite labor market softness. So, if inflation's high, the Fed will not want to cut. Inflation doesn't need to go up from here because, as Damaris will talk about some of the components of it, there's a lot of it that's sticky. So inflation could stay above the Fed's target, for foreseeable future, and it's already been above its target for 4 years. So, that's a long time. But yeah, I do think, the Fed's kind of target of 2 is probably too low. Mm-hmm. So they should probably get more like 2.5, but I'm not on the FOMC, so I don't get to say anything. But we'll see. I think we're going to hear a lot about this all year long, and I don't think there'll be a lot going on. I think the Fed will stay pat here in January, and then we'll kind of just have to see what the data says from here. Any thoughts on that?
I would just say one of the things that can be a little interesting to observe is when the market has baked in a certain rate cut or a certain series of rate cuts, and then they don't happen, that can, cause a little bit of volatility. So like Cliff's saying, we are not going to stop hearing about the Fed and whether they're cutting or raising rates. That's just kind of, again, some of the noise that we're referencing.
Yeah, and the other thing to consider is that we're going to have a new Fed chairman who will be a supporter of Trump's policies. That said, I think I'm hoping the cooler heads of the other FOMC members would prevail and say this is not a political entity. We're supposed to be apolitical and not do whatever the president wants us to do, which would be cut rates to make him look better because things are go. So even when we have a new Fed chair, that does not mean that we're going to have a political Fed. So hopefully whoever that person is does not gain sway. But that'll be something that international participants watch too, because obviously that would not bode well for the treasury market. And so I think everyone knows there's too much at stake to mess around with that.
Great.
Now I want to touch on the yield curve. So if we do get one more rate cut, this dark blue line here at the end, that 3.7 would come down to 3.5 or below it, and we would have our first normal yield curve for a very long time. We had our longest yield curve inversion ever. So this was the peak inversion on July 3rd in that green line. We had a yield curve was inverted for 783 days. The longest time before that was in 1978 when it was 625 days. So a lot longer than the previous one. And we still didn't have a recession. So the inversion means when the 10-year bond is below the 10-year treasury is below the 2-year. So you can see here at the 10-year on the green line was very low, below 4%, while the 2-year was all the way up at 5%. So big inversion. That's finally normalized now. Yield curve inversions usually predict a recession, but clearly they did not in this case. But that said, they're not great at predicting them, and there's usually a long lag, so it's pretty unpredictable when you have an inversion. So I think the Fed's done a good job. The government's done a good job of kind of keeping things going, even though we're in a rate cutting cycle. So knock on wood, so far so good. No recession worries today. And so when we're talking about rates, that really leads to, like I said, that trade-off between labor and inflation. Those are the Fed's two mandates: to keep prices stable and to ensure solid employment market. And so I'll turn it to Damaris to kind of look at those two areas of the market.
Yeah, so we're finally talking about the labor market, something that has gotten quite a lot of press recently. A little interesting too with the experience we had recently with the government shutdown and kind of the lack of data during that period, and then kind of, catching up on that data. But I think the high point to understand here is that labor is cooling. The labor market is cooling. It's not collapsing, but it is in a little bit more of a precarious spot. So there are important things to consider here. Obviously, we think about unemployment. That is a top line number that a lot of people anchor on. That's kind of remained low, around 4.4%. But unemployment alone misses the story. Participation and hiring matter too. And a softer labor market doesn't necessarily equal an immediate consumer breakdown. So to dive into more of the specifics, there are also sectors, and different sectors are experiencing different employment or unemployment challenges. I would say one thing that I have found to be very interesting is, as I personally know, a lot of people who work in marketing, seeing the marketing sector, kind of how that has transitioned a little bit with the ability of AI to do some of the copywriting that people used to be hired for, some of the editing, some of the content generation, things like that, where maybe you're not having to hire somebody anymore to do that, but maybe in turn you want to hire somebody on your team to help integrate all of the different AI softwares that you're using in your business. So it's important to remember there's sometimes yin and yang, and there's been some sector growth within healthcare, and food services continued adding jobs. Retail saw some losses. And one other thing to note is that 2025 layoffs were the highest since 2020. Now, we remember what was happening in 2020. There were a lot of really tough things happening, a lot of loss of life, certainly, but also economic challenges. And compared to that, 2025 layoffs they're higher than they have been in the more recent past. Couple of other comments to make on this is, when we're talking about unemployment, I also mentioned participation in hiring. So as immigration has changed a little bit, the Congressional Budget Office estimates that net immigration was 1.6 million lower in 2025. So obviously that's going to change how certain things look. Labor market softness, it's not just about supply. Some of it reflects demand side pressures. And some companies also appeared to pull back on hiring to offset higher costs from tariffs. So if you're thinking about the uncertainty that comes with tariffs potentially being in place, you might not want to be adding to your team or hiring. So it is interesting to kind of think about all of those factors and how they work together. heading into 2026, labor markets remain somewhat in a precarious spot, which could weigh on the balance of the risk. I think when we consider things that are positives for 2026 and negatives for 2026, labor does feel a little bit like a tough thing. But there are some early signs of stabilization, and there are some alternative indicators such as ADP, which are still signaling slow growth, but they suggest that the worst might be behind us. So we talk out of both sides of our mouth sometimes about these things, and it'll be interesting to see how the labor market progresses. In labor supply too, we've got obviously these charts here. So supply side of the U.S. labor market, so the top left chart here is showing that labor force growth has been positive in recent years with increased participation from foreign-born workers. That's where we start to talk about immigration. With immigration policy being now more restrictive, this dynamic has actually reversed course. The bottom left chart now, looking at that, shows labor force participation rates. Rate for people aged 18 to 64, you can see that pointed out there. It surpassed pre-pandemic levels, which is good, but total labor force participation hasn't. So the right-hand chart also shows that businesses aren't just having problems finding enough workers, they're also having a difficult time finding quality workers, which is certainly an important factor in reducing turnover when you are in a business and you're employing people. Maybe we can, Cliff, do you have any comments before we move on to inflation?
No, I think you did a great job.
Okay.
The immigration part is a big one, and that chart is really surprising to me on the upper left. Apparently our Q&A box has not been working. So I think they opened up the chat box to everybody to submit any questions, comments to us. So hopefully that will work for everybody. Sorry about that.
Keep going here on inflation. So this chart is breaking out the different types of inflation, the different components of inflation, contributors to headline CPI inflation, which is the number that a lot of people anchor around. I think the high points here to understand are shelter inflation is easing a little bit slowly. Services inflation still remains sticky. Inflation progress is uneven also, so certain things are changing. It's not a linear process, and inflation is one of the things that people are still talking about a lot. While service inflation has shown recent firming, it's unclear if this trend will persist or if goods inflation will become elevated if higher tariff costs pass through. The trade-off between inflation and labor has been a recurring theme in Fed speeches. Cliff was mentioning this earlier. Increased inflation concerns in the fall of 2025 drove Kansas City Fed President Schmid and Chicago Fed President Goolsbee dissents at the December FOMC meeting. So while it's not unanimous, some Fed members do appear comfortable with inflation running slightly above target, which again is kind of what Cliff was referencing before. Is the target of 2% really realistic, or should it be a bit higher to feel comfortable? So the other thing I would point out here is just towards the end where we are right now, you can see a couple of changes. I mean, this graph points out that shelter is moving down. Auto insurance seems to have moved down recently. Core goods, a little bit. And then also food at home, not as bad as it was, say, in July of 2022. So a lot of interesting things to consider here. Also, energy seems to be a little lower as well. Cliff, anything you want to add on inflation components?
No, I think that's good. And I think, yeah, energy, as I'll touch on in a minute, I mean, that's one of the areas of deregulation the government's focused on. So, you know, Trump's like to say drill baby drill. I think there'll be some of that coming back for now during this administration at least. But yeah, I think driving down energy costs, gas costs, that's a big focus for them. So I'm not saying there was any reason they went into Venezuela for the oil, but there's definitely
but there might have been.
Might have been.
Yeah. So moving to the next slide, the one big beautiful bill, we've been talking about it a lot. In particular, we've been talking about it as it impacts both our individual clients and our business owner clients. It's kind of something that is projected to actually really could help GDP. There's been some focus recently. Scott Bessent's 333 plan included the idea of increasing GDP growth. And yes, we have deficits. Yes, we have some things that we're facing from a budget perspective. But if we can increase our growth, that kind of helps the picture. So a couple of things I'll say here. Bank deregulation improves credit availability at the margin. We're going to talk about bank deregulation a little bit more in the next slide. Tariffs are inflationary, but they haven't broken the system. So these are kind of cross currents. They're not necessarily runaway forces. But when it comes to the actual features of the one big beautiful bill, some of the things that are very helpful for business owners is that they are now allowed to immediately deduct investments in equipment, which is called bonus depreciation, and also research and development, rather than having to take those deductions over several years. So this really helps with cash flow from a tax standpoint, which then gives them more cash to invest back into things, or maybe even encourages them to purchase equipment that is needed for their business. The other thing that is a feature of the OBBA is increased interest deductions. So that raised the limit on deductible interest expenses, which just makes borrowing less costly from a tax perspective. Again, both things that are favorable. And this is really projected to be a big tailwind towards the economy as we're thinking about this upcoming year. One part of it is businesses. The other part is the individual. Individuals are still experiencing those lower tax rates that they'd had for the last several years. And then also a couple of other features, such as the senior tax deduction, just provides a little bit, potentially more cash flow, less going to taxes, and that can make people feel better about spending money. Cliff, what do you have to add here?
Yeah, no, it's supposed to help. Yes, the higher earners more than lower earners, but it does help everybody. So I think this is going to benefit everybody's tax bill, which, so now when people get more money back from their taxes, they're likely to go spend that money. So maybe not what we'd recommend they do, but that's what happens. So I'm going to touch on bank deregulation only because it's an example of deregulation that is going to happen. What the focus is on. So the administration, especially having a majority in the House and Senate, is focused on deregulation of energy, finance. So we'll talk beyond just deregulation of banks. I'm having a hard time saying that word. M&A doubled in 2025. We had an FTC under the Biden administration that was very antitrust, very anti-big companies merging. We had some mega mergers last year that probably would not have happened before this year. So that is expected to continue. That in turn has kind of opened up the IPO market. So we've seen more IPOs. And our one investment that many of you might have exposure to, private shares, they just announced another potential IPO. I think they have 15 in their portfolio that are likely to have an IPO this year. And many of them are the top 10 holdings. And a lot of these numbers are pretty eye-popping of, where they're valued. And when they IPO, they'll be double what they were valued. So that's a very exciting area of the market. That's been pretty closed as rates rose. But we're also going to see deregulation in healthcare, technology, and housing. They want to get more housing built to drive down housing prices because that's obviously been a pain point for many Americans. And so on the bank side, and we've seen this more in the U.S. than outside the U.S. As you can see here, like some banking in Europe and especially Switzerland, which had Credit Suisse collapse 2 years ago now. Geez, time flies. But in the U.S., we're actually getting less constrictive. So our top 13 banks have this isn't a staggering amount of money, but it makes a difference. They have $200 billion in excess reserves. And if they can deploy those to other areas beyond just, lending, so yes, it could help with lending, but if they were going to do M&A or share buybacks, those things could lead to more profitability for banks. So I just thought it was notable here that that's a big number of a change in lending capacity, 2.6 trillion. Whether we see all that or not, we don't know, but just the fact that it could happen is interesting. And Damaris touched on tariffs a little bit, but which we kind of still have to see where this shakes out. So the one thing I will say is it's steadily increased throughout the year. If you look at that black bar in the middle there, it kind of shows you the effective tariff rate each month. So you were at 2.3% in January. The black box doesn't go through December, but we have kind of an estimate of what that is at the end of December, which was up to almost 16%, 15.6. So it's definitely gotten up there. Now the Supreme Court was supposed to rule yesterday on some of the tariffs under the International Emergency Economic Powers Act, IEEPA is a little easier to say, which led to about $130 billion worth of tariff revenue. And so the question there is, if they rule against those tariffs, well, then there's going to have to be refunds to those companies. But the administration said they would turn right back around with the same exact tariffs under a couple other different methods that they have under Section 122 of the Trade Act or Section 232 of the Trade Expansion Act. So there's other levers they can pull. So even if they said no on that, they'll say, okay, well, we're going to do it with this. So we'll see, how that all shakes out. I think bottom line here is the tariffs are here to stay. I do think we'll hear more noise about that as the year goes on. So, I don't think that it's over. We're still in negotiations with Canada and Mexico. And, there'll be other things that come of this, because it's a key tool for the administration, for Trump in particular. And, it's not over, but at least it's calmed down. We know what they are. Companies haven't passed as much of the costs through as they could have, so they've absorbed a lot of the costs. But I do think that could have some pressure on inflation if they start passing those costs through. Walmart said that they were starting to pass some of those costs through, and that's the largest retailer, obviously, for low cost shopping. So if they're going to be passing things through, I think that could be negative for inflation in terms of driving it up a little bit. So I don't think we've seen the full impact of what tariffs could possibly do to inflation. But as Damaris said, it hasn't broken anything, and we're still okay. So we'll see how this is going to be a key thing to watch in 2026, I think, to see how it plays out.
That's a great point, Cliff. And as we talk about tariffs and potential higher costs for goods, we transition very nicely into consumer finances. So a couple of interesting charts here. On the left, we show total assets and liabilities of U.S. households. Consumer balance sheets actually held up remarkably well during the pandemic, thanks to the massive fiscal support. On the top right chart, we show the household debt service ratio, which is the percent of after-tax income used to make payments on mortgages and other consumer debt. After declining to a 40-year low during the pandemic, aggressive Fed tightening the rates has contributed to higher household borrowing costs and also a rise in this metric as well. So you kind of see that being reflected there towards 2025. On the bottom right, we see flows of auto loans, credit card debt, student loans, mortgages into 30-day delinquency. So after falling after the pandemic, delinquencies have actually been steadily rising and now are above pre-pandemic levels. The one comment that I will make on this too is that student loans in particular are beginning to impact people in a more substantial way because missed payments are now appearing on credit reports. So if you think about somebody who wasn't really experiencing a lot of consequences for missed payments on their student loans, who is now starting to reap those consequences, that could really hurt their credit score, which in turn hurts borrowing potential for younger people. And again, those are a lot of the people who are trying to buy houses and feel like they're having such a hard time, quote unquote, surviving in this economy. So just kind of some interesting data there. It should also be noted that kind of the cash reserves on average for U.S. households are not necessarily in a great spot. We tend to be a very consumeristic society, and I think that is sort of reflected there as well. The next place that we're going is actually talking about the K-shaped economy. I think this is something that really explains how a lot of us feel right now. So the K-shaped economy, as we're looking at this chart, we see this divergence between these two lines, the darker blue line obviously trending up and the blue line, lighter blue line trending down. The lighter blue line represents under 50,000 income, and then above 100,000 is represented by that other darker blue line. It's important to understand this, I think, because it really explains some of the news that we are hearing. And I feel like I've been hearing for a very long time, oh, the economy is so difficult. We're, having such a hard time, and consumer sentiment is down. And then you look at things like stock market returns and at least great yields on cash. Mortgage rates aren't amazing, but they're not as bad as they have been at different points in the past. And you kind of think, well, does the consumer sentiment actually reflect what is really happening? And I think the K-shaped economy explains this perfectly because as we see this K-shape, people who have higher income and higher income households, which honestly is probably most of the people, if not all of them on this call, those people remain very resilient. Lower income households are really feeling more of a strain. They are more impacted by changes day to day and in the goods that they need to purchase or the services that they need. And if you just take aggregate data, that kind of hides the divergence between higher income and lower income people. So it's very interesting to think about. And I think kind of also helps to explain some of where younger people, again, starting out in life, maybe in first jobs or looking to buy a home, they might be feeling the impacts of this in an outsized way compared to people who have higher incomes and are more established.
Yeah, and I think we hear about the resilient U.S. consumer or the strength of the U.S. consumer, and when you break it down, doesn't always maybe look that way because the top 10% of people make up more than half of consumption. So when you have the top 10 being half of what's being bought, that's that kind of says something. And then I listened to a call yesterday with Lizanne Saunders from Schwab, and she was saying that retail sales number that we see, that's a nominal number. You can look at it on a real basis if we look at the GDP and say, well, what did it do outside of inflation? Well, actually, retail sales has been pretty flat. So, I think we hear a lot of this is like, oh, consumption's great. Consumption's about the same, and it's driven by the top 10%. So I think there is a real story here to the bottom, half of the economy that, this inflation that we've seen is still hurting them. They haven't kept up as much. So. I think I'm supposed to talk about this slide, which I didn't really want to talk about, but we have to look at it at least and acknowledge that this is an 800-pound gorilla in the room that we don't want to disturb. So everyone knows this is an issue. I think interest cost is the biggest issue, right? Because that's the money that we actually have to pay toward this debt. So the Fed is issuing bonds at higher rates. That's going to eventually lead to higher cost. The one piece of good news I heard on that call yesterday again was that 2026 will actually be the first year in a while that we'll see less treasury issuance than the year before. So that's good. We're issuing less debt this year. So that's something. And I actually have seen, we don't have it in here, but I've seen a chart that shows like the deficit actually has been going the other way. So that could be a good thing. We'll hope that trend continues. But clearly, some things need to change, whether that's cutting costs or growing into this, as Damaris talked about with the 3-3-3 plan. So it's not this is not a crisis, but it is something that we need to obviously pay attention to, and I think everyone is paying attention to it. It's just getting to a place where people agree that this is something that we need to address sooner than later. I will say this line with the OBBA here, which I didn't mention when I was talking about tariffs, so that over 10 years is projected to be 4.5 trillion. Well, the last year we took in 195 billion from tariffs. So if that number just stayed the same, and that was with those low numbers in the beginning. So that number, I didn't do the math before talking to you guys to think about what that number would be with like a full 16% over a year, but call it a lot more than that. Well, if it only stayed at 195 billion in 10 years, that would bring in 3.6 billion or trillion in revenue. So that in theory would offset a lot of that 4.5 trillion that's estimated from the OBBBA. So just an interesting thing to think about there. Know here a lot about the dollar. Damaris mentioned how it's been positive for assets outside the U.S. for U.S. holders, and that's true. This is kind of sorry, we're on the wrong thing here. But if you look at the chart on the bottom here, it kind of shows the DXY index, which is the dollar against a basket of 10 major indexes. You can see it really started coming down in 25, and that first half was really driven by policy, right? Like trade policy, what was happening, the uncertainty around it, rate cuts in 24 that were filtering through to the dollar to say, well, I can get better rates, elsewhere on a relative basis than the U.S. So that drives the dollar down. And then we saw, kind of a slight rebound in the second half of 25, just based on economic resilience. But I wouldn't expect the dollar to re-enter a path of strength. I mean, the dollar's it's a cyclical market. So when you get sort of these moves, they tend to persist. If you look at the chart on the top, it shows that the U.S., the top line, the dark blue line, has a downward trajectory that represents that we're more in a dovish cycle, that we should be probably cutting rates, that rates will be going lower, while all the other countries on here, with the exception of the UK, are moving the other direction. So that makes those relatively more attractive in terms of, those are higher. I can hold my currency at a higher rate there, depending on where they're domiciled. It depends on the taxes and hedging and all that. So it just makes it cheaper, probably or more attractive to hold other currencies than the dollar. So I would expect dollar weakness to persist. It's not necessarily a negative thing. It just kind of is a thing. So anything to add on that one, Damaris?
No, I think that's great, Cliff.
And I think that, a lot of people have seen or have had more interest in gold. And this is not just a U.S. Thing. It's been a global thing. I was telling Damaris, I heard about these gold markets in China where the lines are just crazy to buy gold, for individual people to buy gold. I thought this was just an interesting chart to show the dollar over the year, which I know this looks drastic. It's really about a 9% decline. So these are relative scales. The dollar index scale is on the right-hand side, and gold is on the left. Gold has been pretty interesting in terms of almost doubling over last year. But this dollar decline is really only about 9%. So don't make it. It shouldn't be too scary of a chart, but it does look dramatic based on those relative lines there. But I do think it's interesting that it's not just a U.S. phenomenon. I think people are worried about this debasement elsewhere and kind of having a safe place to put money. And we have seen a lot of risks in the market. So I think gold has just kind of been a safe haven type of asset, and it's one of those things like a momentum thing. I mean, we saw silver now getting piled into. So I think these trade ideas pop up and people get interested and rush to them. So there's been a lot of flows into the gold ETFs. That's actually what this performance is here, GLD. But yeah, gold's an interesting thing. The last time we saw this was 2001, and gold came way back down. So it stayed there for a very long time until the crisis, and it went up, and it stayed flat, and then now it's up. So gold's a hard one because it has no it's like Bitcoin has only the value that people assign to it. So I always think of that song in Rudolph the Red-Nosed Reindeer about silver and gold. That's only worth for the joy it gives its owner. So anyway, just thought it was interesting because it's been a topic that's come up.
Yeah, the comment I would actually make before we move off of gold too is that just as I'm interacting with clients, it tends to be that when gold starts to move up, people come in and they're really interested. Hey, I want some gold. Do we need some gold? And if you want to go buy some gold and that feels like something that you hold on to, that you keep, that gives you a little bit of an easier time sleeping at night, okay, knock yourself out. But generally speaking, it can be quite volatile. And that's something that's kind of important to consider, as well as the fact that when it starts picking up traction, it's often priced higher. And so you're spending more to buy that same amount of gold than maybe you would when people weren't talking about it. So it can be a little bit of a trendy thing, but again, it's certainly not something that we're opposed to having some of.
Again, I see that Phil got a comment in here. Hopefully our chat box is working for any questions since the Q&A box didn't seem to appear. So please, if you have anything, I can put it in the chat. We'd be happy to touch on those as we near the end of the presentation here. But I would touch briefly on sort of geopolitical risk and be the negative Nelly before Damaris can be the positive person, the Pollyanna for us. But there are risks out there, right? So this is a indicator that BlackRock puts together. You could Google this if you'd like. And I'm happy to say that we're kind of flat for geopolitical risk at the moment. The top 10 that they have are the Middle East, global technology argument between kind of the U.S. and China, cyber attacks, terror attacks, and then global trade protectionism. These are all kind of high ones that they think are risks. Interestingly, going into each of those, you can look at each of these on like an individual basis. None of those are really high at the moment. The ones that are highest on there are more of like the U.S. China, and actually that's down too because Trump just met with Xi in October, and they have plans to meet again. So that's actually down now recently too. But there have been some emerging markets political crises. We've seen these youth movements where they've kind of been against the government taking away social media, or there's not good opportunities for jobs for them, and it's been pretty widespread. There's Bulgaria, Morocco, Kenya, Indonesia, Peru, the Philippines, Nepal, and Madagascar. So all those have had kind of civil unrest from the younger population. So that seems to be one that's could still be popping up. And then there's North Korea conflict, and then they also look at European fragmentation. So these are kind of these big geopolitical things. Could happen. We don't know. Things could spike. They could go away. But at the end of the day, as we've seen with the markets, yes, they can impact the markets for a little while, but over time, these things generally don't have as much an effect on investing as they do on our psychology. So.
Great data there. And now that Cliff has kind of broken you down a bit, I'll build you back up as we finish out this webinar for today. But there are reasons for optimism in 2026. And one of those being, continued AI innovation and rollout. There is true productivity around it. It's not just buzzwords. As we saw, it is supported by actual underlying financials and investment. There's also the potential that interest rates get more cuts. That could be helpful. There's also some infrastructure, and that is related to energy, yes, but also then there's some reshoring as a result from tariffs. Could be good. There's also inflation, which is easing a little bit, and we have seen lower energy prices, which help consumers. And the final comment that I would make, obviously, there are a lot of things on this list that we thought could be reasons for optimism in 2026. But as we look towards this year ahead, the investment landscape, it presents both familiar and new challenges, just like every single year in the markets. And what we know is that uncertainty isn't new. Markets have navigated waves of innovation, political transitions, monetary policy shifts, currency fluctuations, financial disruptions many times before. And so what matters most is, tongue in cheek, as I say that as at the end of a Outlook webinar, what matters most is not actually predicting every twist and turn. It's really more about maintaining disciplined investment strategies that are aligned with your specific goals. So we say that all the time. We say that every time we talk about things like this. There are a lot of interesting things happening. We love researching and talking about them. But at the end of the day, what really matters is finding the right allocation, staying disciplined to it, and then, continuing to be in touch with what your goals are, how they change, and then adjusting as needed. So I would just love to thank everyone for joining this webinar, for spending the time with us and indulging us as we can get a little nerdy on some of these topics. We do love our charts, but overall, we do greatly appreciate the trust that our clients have in us. And I would just say, if you have any questions, you can submit them now, but this kind of concludes at least the formal element of the presentation. And Cliff, you have anything else to add?
Yeah, no, I apologize if that chat box or the Q&A box didn't show up, but please email us or call with questions. We're happy to answer them and offline and to talk to you about anything you're concerned about.
All right. Thanks again, everyone. Have a wonderful day, and you know where to find us.